Hello, and welcome to all who have joined to watch this video. This is Edgemoor Investment Advisors' second quarter 2022 market review and outlook. I'm Tim Coughlin, and I am joined today by my colleague Gay Truscott. We are pleased to be making this presentation for our clients and friends. Our agenda for today will follow the quarterly newsletter, which we sent out last week, and is also posted on our website and blog. Gay will start with a review of the current market conditions and then discuss inflation, interest rates, and the overall state of the U.S. economy. I will then provide Edgemoor's investment outlook, followed by a review of two securities we are currently buying, CVS Health Corporation and Verizon Communications. So let's get started with Gay.
Thank you, Tim. The second quarter of 2022 saw a continuation of the negative momentum that began in the first quarter. Rising inflation and interest rates, as well as slowing growth in the U.S. and abroad, caused sharp retreats in both the stock and bond markets. As shown in this slide, the S&P 500 index posted a negative total return of 16.5% in the second quarter, putting it in bear market territory for the year with a negative return of 20%. The tech-heavy NASDAQ fared even worse, down 22.4% for the quarter and 29.5% year-to-date. This marks the worst first half of the year for equity markets in nearly 50 years. The next slide shows that the bond market, as measured by the Bloomberg Barclays Aggregate Bond Index, also posted negative returns, falling 4.7% in the quarter and 10.3% for the year, as rising interest rates caused bond prices to fall at a rate that exceeded their interest payments. A major contributor to the market volatility this year has been the sharp rise in inflation. The Consumer Price Index, or CPI, the primary measure of inflation, soared 9.1% in June, an unexpected increase from the 8.6% rate in May. It was led by sharp increases in prices for energy, food, and shelter, and is the highest level of inflation in the U.S. since November 1981. The acceleration of inflation is likely to prompt the Federal Reserve to continue its aggressive interest rate tightening by raising the Fed funds rate another 0.75% to 1% this month, on top of the 0.75% increase in June, which was the largest monthly increase in short-term interest rates since 1994. This slide shows how much interest rate forecasts have increased for the remainder of this year, shown in the two right-hand bars. Expectations are now for the Fed funds rate to reach 3.5% to 3.75% by December, sharply higher than the 2.5% expectation just last quarter. But not all the news is bad. Energy prices, which contributed roughly half of the June inflation rate of 9.1%, have declined substantially since then, with crude oil prices dipping below $100 per barrel in July, the first time since early May, and significantly below their peak of $130 per barrel in March. In addition, this slide shows the core inflation index, which strips out volatile food and fuel prices. It has declined steadily from a peak of 6.5% in March to the June reading of 5.9%. So, if these trends continue, we believe they could bring down the overall inflation rate in the coming months and reduce pressure on the Fed, allowing it to slow future interest rate increases. Now, we do have to mention the R word, recession. The economic debate has now shifted from whether the economy will slow this year to when and for how long it could move into recession. A recession is generally defined as 2 consecutive quarters of negative GDP growth. This slide shows that U.S. GDP shrank at an annual rate of 1.6% in the first quarter. This was the first contraction since the onset of the pandemic in early 2020. Estimates for second quarter GDP range from negative 1% to positive 3% growth. While we would rather not see a recession, the silver lining in a recession scenario is that an earlier recession means an earlier recovery. In other words, the sooner a recession arrives, the sooner inflation pressures will ease, and the less the Fed will have to tighten interest rates. The biggest driver of GDP is consumer spending, which typically accounts for up to 70% of U.S. economic growth. The Commerce Department recently reported that consumer spending slowed to an annual rate of 1.8% in the first quarter of 2022, weaker than the 3.1% initially reported. After several quarters of post-pandemic surges in consumer spending, consumers are now cutting back on their spending on food, clothing, home furnishings, and appliances due to soaring prices and long supply chain delays. In addition, the effects of pandemic-era stimulus measures have faded, forcing consumers to further recalibrate their spending. But overall, the current rates of consumer spending are in line with historical averages. Finally, let's talk about corporate earnings, as we always do. Consensus estimates for 2022 corporate earnings have so far remained little changed, forecasting nearly 10% earnings growth for this year to more than $228 per share from $208 per share last year. This is despite the fact that 70% of the companies that have issued guidance so far for the second quarter have trimmed their earnings estimates. So we are watching carefully how this earnings season unfolds and would not be surprised to see a downward revision in consensus estimates for full year 2022 earnings. Now I will hand it back to Tim to discuss our outlook and 2 of our selected securities.
Thank you, Gay. Our investment outlook is divided into 2 segments, near-term and long-term. Our near-term outlook is for the market to remain volatile in the second half of the year, continuing uncertainty around inflation, interest rates, GDP growth, and the geopolitical risks in Ukraine and China are likely to keep investors jittery. Longer term, our outlook remains optimistic. Pillars of strength in the U.S. economy include continuing low unemployment, positive, albeit slowing, annual GDP growth, and strong overall corporate earnings and balance sheet strength. Also, in market downturns like the first half of 2022, there is a potential for upside. That is, a resetting of asset prices can present a favorable entry point for long-term investors. The forward price-to-earnings ratio of the S&P 500 index has declined to approximately 16 times from a high of 23 times in 2021, making valuations more attractive than they've been in several years. Lower valuations mean that the long-term return potential of equities has improved for investors. An analysis of the 12 bear markets going back to 1945 shows that the S&P 500 index has returned an average of 43.7% in the 12 months after a bear market bottom, Predicting the timing of a bear market bottom, however, is next to impossible. So, what do we recommend to investors during these uncertain times? Our investment approach remains unchanged. Don't panic. Don't sell good investments at depressed prices. And maintain a long-term, disciplined approach to investing in high-quality companies that can withstand market downturns. We also continue to take an active approach to individual equity and income investment selection and remain committed to our long-term, value-oriented investment philosophy. Our equity investment strategy remains focused on seeking attractively priced stocks relative to their earnings growth and stock appreciation potential. In the current investment rate market, our income investment strategy favors more high-yielding dividend-paying stocks than bonds. We have not been active buyers of fixed-rate bonds during the low interest rate environment of the last decade, and especially during the past 2 years, when rising interest rates have caused bond prices to fall significantly. Instead, we favor high dividend securities with a history of dividend growth and the potential for increasing payouts over time, such as REITs, utilities, pipeline companies, and preferred stocks. Overall, this is a challenging time for all investments, but we remain committed to selecting both equity and income securities with the potential for attractive, long-term positive returns over full market cycles. Our first company for review today is CVS Health Corporation, an equity investment, which we are buying for its solid earnings and capital appreciation potential. CVS is the nation's foremost integrated healthcare company that includes CVS Pharmacy, a retail pharmacy chain, CVS Caremark, a profits benefits manager, and Aetna, a healthcare insurance provider. Company revenue in the first quarter of 2022 totaled $76.8 billion, which represented an 11% increase compared to the first quarter of 2021. And adjusted earnings of $2.17 per share for the first quarter exceeded analyst estimates. These positive results were driven by growth across nearly all business segments and prompted management to raise its full-year 2022 earnings guidance. Under new CEO Karen S. Lynch, the company has successfully integrated its retail, pharmacy, and health insurance operations, which should enable CVS to accelerate earnings growth over the long term. CVS is focused on making healthcare more accessible and affordable, as well as improving health outcomes for all its customers. About 70% of the U.S. population lives within 3 miles of a CVS store. This extensive reach should make it easier for an aging population to get the advice, medicines, and care they need to stay healthy and avoid more costly treatments. The company's financial position is strong, and it generates significant cash flow that has allowed it to pay down $21 billion of debt since the close of its Aetna acquisition. As a result of the reduced debt levels, the company began repurchasing stock again in 2022 and increased its quarterly dividend by 10% in February. The annual dividend has grown at a 10-year compound annual growth rate of 13%, and the shares currently yield 2.4%. CVS shares are currently priced at 11.2 times forward earnings, which is well below the 16 times average forward price earnings ratio for the S&P 500 index. We believe CVS shares represent an attractive, long-term equity investment with robust growth prospects and a solid dividend and above average total return potential. Our second investment for review today is Verizon Communications, Inc., which we are buying as an income investment for its high, reliable dividend. Verizon is one of the world's leading providers of communications, technology, information, and entertainment products and services to its customers, businesses, and government entities. The company has two reportable segments, Verizon Consumer Group and Verizon Business Group. Verizon is primarily focused on the wireless business, where it believes its networks provide multiple avenues for growth. The firm has taken steps to ensure it remains well-positioned in the traditional wireless business by building fiber deep into major metro areas, acquiring a large amount of telecom spectrum, and ramping up spending to put that spectrum to use. In the wireless business, which generates about 70% of total revenue and accounts for nearly all of Verizon's profits, the company holds approximately 40% of the U.S. user-paid phone market. Verizon has long prided itself on its network, continually investing in technology to ensure that it delivers the highest network quality to its customers. Verizon was the first company in the world to launch commercial 5G, the fifth generation mobile wireless technology that offers massive data capacity delivered at ultra-fast speeds for mobility, fixed wireless, and computing. As of December 31, 2021, Verizon's 5G ultra-wideband is available in 87 U.S. cities. Investing constantly in both wireless and fixed line technology, the firm has built its reputation around these networks, attracting a large and loyal customer base. Leading scale enables Verizon to generate the highest margins and returns on capital in the industry, despite heavy investment. We consider Verizon a core, long-term income investment holding, as the stock offers an attractive and growing dividend, currently yielding 5%, and is reasonably valued at 9.5 times forward earnings, meaningfully below its 5-year historical average of 11.4 times. This now concludes our presentation. We appreciate you for tuning in, and we hope you have found this presentation informative. Gay, any closing comments from you?
Yes, we do appreciate all of you for tuning in, and we look forward to your feedback as well as connecting with you again next quarter.